I think it's going to be more like 2007, 2008, where it's going to be just a sharp, violent pullback. I think it's going to rebound with a vengeance in a shorter period of time. I think we're walking through a landmine, and I think we're very close to the markets going for a nosedive. Have they topped?
Is the bull rally in metals finally over? We'll find out. Chris Vermeulen joins us today. He is a chief market strategist at thetechnicaltraders.com. Chris, welcome back to the show. Let's just jump straight into it. Gold tumbles 6% today on the 21st of October. Biggest single day drop since 2013. Plunge comes amid warnings that historic bullion rally is overdone. This just came out of the left field, Chris. It was going up parabolically, and then it wasn't like, oh, people were talking about, yes, people have been talking about gold being overhyped for a couple weeks now, but the drop came very suddenly. I'll let you show your charts, but I'll show mine first. This is gold and silver as well. It started, we had this bit of a double top that first came last week, and then it rebounded and briefly touched almost $4,400, not quite, before plunging now to $4,100. Silver, exact same pattern, except even more dramatic of a sell-off. Now it's well below $50. I mean, it's still very high at 48 compared to where it was just a few months ago. So nobody's complaining if you bought several months ago. However, people are asking if this is the beginning of what happened in 2011, which was a peak in the precious metals, didn't stay that high for very long, and then a massive correction by the order of 40, 50%, all the way back down and stayed there for years. I'll let you analyze the charts. I'll let you take over.
Sure. All right. Yeah. Well, if we take a look at the charts, there's a lot to unpack, I think, in the precious metals space. And I mean, I've been talking about precious metals over the past week and a half, really saying like, hey, it's starting to go parabolic. The signs are here. And the big question is, as you just mentioned, David, you're like, out of nowhere, the top was put in, or we had this big reversal. And that's the problem when things get a little overheated. We start to go parabolic. And again, the monthly chart of gold, silver, miners. I mean, if you zoom back in time and you go look at, the previous ways that gold has moved, usually this doesn't end well, right? It's just a typical scenario. You could give this to a fifth grader and be like, what happens? What should happen next after this, right? So that's like the super basic high level. But when we zoom in, you and I spoke a few weeks ago. We showed the intraday charts, and silver was poking up and trying to break to some new all-time highs. And we were seeing in gold and silver some big intraday bouts of selling. So somebody was unloading contracts, slowly getting out. And the market, to me, in the precious metal space, I've been sharing this quite a bit, saying, it's a crowded trade. And a lot of people are saying, well, Chris, it's not crowded. The retail traders are barely even in. When I say a crowded trade, which I believe gold is based on many different things, just the price action is signature of a herd mentality. The volume is a signature of everybody's piling in, chasing pricing. But when I say it's a crowded trade, David, I mean, not the whole world's piling in, just the people who are open-minded, who are willing to potentially buy gold, silver, or miners, or the other metals, are all piling into it. And so it's most people don't hold gold. There's a very small group of people that actually hold gold in their portfolio, but the people open-minded enough to do it are all piling in, and now they feel like they're missing it. And we saw this like over the past week. You could cut the air with a knife, the FOMO that was in this space, or people who aren't in it. And so there's some pretty interesting charts when we look at the daily chart here. Gold is starting to have some big back and forth swings. I don't think this is the top yet. I actually think this is just one of the hiccups along the way of it potentially rocketing higher. And one of the best scenarios is if we go back to 2007, which is the chart on the left. We have the S&P 500 candlestick chart. The yellow line is gold. And on the right-hand chart is where we are today, right now, with the same two things. Now, you and I touched on this in our last talk, David. But what's really interesting of where we're at now is the stock market just had a bout of selling a week and a half ago. And so now it's showing a little bit of weakness. Gold has had a big first pullback right here, which we can see on this yellow chart in the top right. If we go to 2007, it started to have a little bit of weakness, the stock market, and gold started to pull back. Now take a look at this. When I show you the other asset classes, so the chart underneath is GDX, gold miners. And then we have silver, and then we have platinum, and then we have palladium. Look what happens like just near this end where we see gold miners shoot higher, Everybody starts piling into silver, platinum, and palladium. It becomes a bit of a crowded play. And if we were to just kind of fast forward this, you'll notice gold at the top continues to rocket higher. It continues to move up. It moves up it doesn't look like much on this chart because it's condensed, but it still has another big push to the upside. Miners struggle to move higher, but we see silver, platinum, and palladium still go parabolic. They actually take off and pick up speed. Now, if we were to just kind of backtrack to kind of where we were in 2007 and look at where we are right now, notice we've got miners, we got silver, platinum, palladium, all coming to life. This is the first hiccup, the first quick knee-jerk reaction where people who are chasing pricing and buying, over the last week or so are emotional because they bought in emotionally. They have FOMO. So it doesn't take much of a pullback like today to really spook everyone out and create this first move. But I do believe we're going to see, I think the metal space continue to rocket higher. This is nothing but a bull market trying to buck people out of gold. And I think it's going to want to go higher here. But there's no doubt we're on like the last major push, I think, in metals. And then the question is it like 2011, like what you mentioned, do we go dormant for another 10 years after that? And does it cut its pricing? Like, do most things fall 30 to 50 or 60%? I don't know. That's why I just follow price. When things top, I get out. And you don't have to really worry about how long it's underwater because we don't hold it. But this scenario of where we are is like the perfect storm brewing of the crowded play. Everyone's moving into all the precious metals, silver and miners as well. And that tells us that it's, a little frothy and it's going to be a wild ride going forward.
Wild ride going forward. How do you make the assessment that this is the beginning of, going back to my earlier point, a 2011 style crash? I think that is the number one question on investors' mind. Is this just a temporary pullback, or is this ultimately the end? How do we go about making that conclusion? Maybe you can just pull up a chart of 2011 and compare that to what's going on right now. Looks awfully similar to the top of 2011, doesn't it?
Now, are you talking about in gold miners or the stock market itself? Or are you talking gold?
Let's talk about gold, but gold miners as well. I mean, gold miners peaked around that time, and I think gold miners started falling before gold, if I'm not mistaken. Yeah. But the metals complex overall. Let's take gold as a proxy, yes.
Right. So I've mentioned this many times over the past year of you and I speaking together that eventually, when I think we have like an economic reset and when gold finally does peak, it's probably going to pull back 30, 34, 35%, somewhere in there. And that's kind of, if we go back and look at the 2011 peak, the market pulled back about 45%. In 2008, during that financial crisis, it pulled back about 34% or so. I do believe eventually, using just Fibonacci retracement, based on the size of this run, there is potential for gold to pull back to the sweet spot. And the sweet spot is between the 38% pullback all the way to a 61. And so we could see this pull back 27% all the way down to 45%. That is typical. That is how the universe works based on Fibonacci theory. And also historically, we've seen prices in gold. So when this does come to an end, wherever the top is, we still need to wait for the top to be kind of nailed down for gold. It could be much higher still. Then we can calculate, okay, where should it settle out? And obviously you don't want to be holding it as it goes down into these levels. There's going to be a time where you might want to actually like lock in profits, lock in gains on gold, because it could go dormant for 6, 8, 12 months and lose 20 to 40%, or it could go dormant for a decade, right? And that's the most expensive thing us as investors or humans have is time. So who cares if you don't own your favorite asset for a little bit? If it's putting in a top, just buy it back later at a cheaper price, or potentially even pay a bit higher price later, but after it's stabilized and it's ready for another leg higher. So that's the way I look at gold. And I believe we could go into a very big correction. Now you mentioned, David, is it going to be like 2011? I mean, that was a really long dead period. I think it's going to be more like 2007, 2008, where it's going to be just a sharp, violent pullback, and then it's going to recover, because I think there's a lot going on right now that's going to spur gold for another big leg higher. So I don't think it's going to be like the 2011 in terms of time. It didn't take 10 years to come back. I think it's going to rebound with a vengeance in a shorter period of time.
Gold and silver have reached historic highs, and amidst this crazy bull rally, more investors are turning to hard assets to protect their savings. But what if instead of just holding your gold as a savings vehicle, you could actually earn income from it paid in gold? So now it's not just in savings, it's also an income vehicle. That's what today's sponsor, Monetary Metals, helps you do. They're changing the way people think about investing in precious metals completely. Rather than letting your gold sit idly or paying fees to store it, now you can get paid to own it. Right now, through their marketplace, you can earn up to 4% yield on gold, paid monthly in gold. Your savings grow in ounces, not dollars, and stack on top of any price appreciation. Thousands of investors are already earning real yield in physical gold and silver through Monetary Metals. It's time to see how it works for you. Go to monetary-metals.com/Lin. Link down below or scan the QR code here to learn more. Rebound after the violent pullback, you mean?
All right. After we see like a 30% or so pullback, I think it's going to rebound and stabilize. And I think it's going to go something like this. Like, I think we're going to see another big leg to the upside. So like, for example, if we were to use Fibonacci extension right now, we can say, okay, based on this low, based on the high, this is just the current high of gold. It may be higher later. But if we come down and settle into this 50% retracement, this tells us where the next upside target for gold is. And this is going to be really exciting because, you know, when gold comes down into this area, it's going to rally up to 4,800 and then about to 6,500. So there's quite a bit of potential still to the upside. I don't think it's going to quite get to this level on this run. I think we're going to stall out probably 48, maybe 5,000, maybe. I'm not sure. But we'll be able to calculate where gold should run. But right now, gold has blown past all of its Fibonacci targets to the upside. So it is in no man's land. It's just bubble phase. And this is, you know, you nailed it right at the beginning. Like, how do we know when it's going to, it just came out of nowhere. Well, that's what happens in a bubble. It just bursts out of nowhere and you don't know when. And so that's why traders are on edge. That's why we're seeing heavy selling. Miners are down over 10%, 11% today. Silver and gold both down really big. It's because people are worried it's going to be the burst. But I think this might actually just be kind of the first pullback before we have another push higher going forward.
I have a couple of follow-up questions. The first is, you mentioned the top. Nobody knows what the top is. You even mentioned yourself on my show many times that you don't pick tops and bottoms. It's not really something you do. It's not even possible to do on a consistent basis. You just follow momentum. So right now, currently as we're speaking, the momentum is on the downside. Somebody who is a trader or even just a casual investor might look at today's price action. If you want to just pull up a price chart of silver intraday and help me illustrate the point here, Chris, you might look at a chart like this and say, whoa, okay, now I'm starting to worry. Even if I had bought weeks ago, it looks like profit selling's taking place. Maybe I should be taking profits now myself while this is happening. We call that panic selling. How do you talk somebody through that process? Should they be selling right now into this panic, if you want to call it that?
Yeah, well, it really depends on the type of trader you are. You're saying momentum, and generally when you're talking about as a momentum trader, you're usually looking at, you know, maybe a 30-minute chart, something that can carry a pattern over several days. There's no doubt the trend is down on an intraday chart going back the past few trading sessions. In the grand scheme of things, if you are a swing trader, technically, it is still holding up. The moving averages are all still sloping up. Price is pulling back to the 20-day moving average, which is this pink line, which is a natural pullback level. I wouldn't be panicking out here at this point. I mean, I think most of the damage has just been wiped out. If you sell right here, you're probably going to be exiting at a point where it's about to bounce and want to go higher. But yes, there's no doubt people who have been piling into silver over the past month, they're right back down to kind of where they are, where they entered. And now it has a pretty scary looking chart pattern that if it does continue, it's going to be back down into the 30s in like 3 more days, right? So it carries a lot of fear. Definitely silver moves at the speed of light. I mean, it takes the elevator straight down. But it's a very small market, and that's why it moves really quickly. So if you are a momentum trader, the trend is down if you're looking at short-term charts. But if you're looking at still as a long-term investor, this is just a pullback within the big picture of a bull market in gold. And I think it could stabilize here, maybe even trade sideways for a couple of weeks. And then it maybe breaks and runs higher to the upside. So I wouldn't be panicking out as an investor just yet. I'm looking to sell my physical gold holdings. But I'm not trying to pick a top at this point. I still have to let a top form. And then when it looks like it's, potentially breaking down, then I will exit. But right now, if we look at silver and we are to just kind of draw what typically happens after this kind of volatility where volume ramps up, it becomes a crowded trade. Usually you get a sharp pullback and then it muscles its way higher. And what'll happen is it can really have some of the biggest percentage moves right near the end of a trend. It could come up and have a couple more of these. And eventually there's this pattern I always look for that silver could make here is three surges to a high. And this pattern is a very, very violent topping pattern, meaning this would be one surge to a high, then it pulls back. We have another surge to another high, and then has a very sharp pullback, and then it does a third one. And usually after that, that's when things actually break, and then it goes into a much bigger, unwinding event. So that's one thing to look for in silver and gold and miners going forward. But right now, a big down day here to support is not something to like throw everything out the window and bail on it yet. I mean, I do think we're close to a top, but it's technically not in place yet, in my opinion.
And one thing that struck out to me is that the stock market didn't fall to the same order. In fact, it was flat today. And so over the past couple of months to almost a year now, year to date, the stock market and gold have been pretty much moving consistently upward together with some deviations here and there. I'm not saying gold is now perfectly correlated with the stock market as a pattern. I'm just saying that's what happened this year. But if today was a down day for everything, you can just write that off as, okay, maybe there was a new shift in trade policy or Federal Reserve policy or whatever the case may be. But it's just precious metals. Bitcoin is up a point and a half. So, 1.3%. So let's take a look at the stock market now. And then towards the end of the interview, we'll get Chris's projections for all assets that we'll talk about. We'll get his key level projections. So stay tuned to the end. Don't forget to subscribe to my channel and follow Chris at his channel down below as well to get daily updates from both Chris and myself. Chris, let's talk about the stock market. Is the stock market topping right now?
It definitely has signs of weakness. Now, there's a few things that if you were to strip away just the price action and you go and you see what different assets are doing, where money is flowing among different assets, I like to peel the markets back and look at it this is from the NASDAQ sentiment chart. So this chart is color coded with my own formula that tells us, is big money moving into equities? Are they willing to take risk? Or are they moving away? And this chart here is giving us a very interesting warning. So earlier this year, just before the tariffs, we had a great big long stretch of the stock market pushing up and hitting all-time highs, yet insider big money was flowing away from equities. It was almost like they knew something big and bad was coming. We saw money, even though the market was moving higher and retail investors were very bullish, big money was rotating out. If you look at where we are right now, we've just had this really long stretch right here of big money rotating and getting away from the equities market. Gold's gone parabolic because maybe this is the last, the last high we see in the stock market for a very long time if we go into a financial reset. So this is a huge warning. And the stock market right now is just kind of flirting with, a few days ago or a week and a half ago, everyone was piling into small caps, micro caps. Everybody was a genius. Everybody's got all-time highs on their accounts. And now the stock market is testing near all-time highs like the NASDAQ, but it's very weak. And we just need to be aware that this drop that we saw, over here, obviously it was a news-driven move, but a lot of damage was actually done on the chart. And this analysis, this internal analysis that tells us something bad is coming, usually we start to see these things, the news starts to hit. And so that's kind of where we're at now is I think we're walking through a landmine, and I think we're very close to the markets going for a nosedive. Have they topped from a long-term investor standpoint? No. We moved to cash a few days ago, just right over here on an open. We moved to cash because this market is unstable. At any point here, it could break down and crash. So we want to protect ourselves because it's not a healthy trend right now. So right now we're sitting in cash, just kind of protecting ourselves. If the market does get some strength to it, then we might get long again and continue to ride this up because it's like an endless melt up in the stock market. But if it rolls over, you don't want to be holding stocks because I think it'll be fairly precipitous. And the way gold is moving and metals and miners and stuff is telling us something bad is brewing in the world and the economy. And it's just a matter of time before it sheds its ugly face on the stock market charts and then hits the news. And that'll be a different game, right? Like people are worried over small pullbacks. I mean, they need to be worried about a much bigger pullback because when it does happen, most people don't want to exit a trade until it gets too big to exit, too big of a loss. And that's the worst part is you get down 20, 30%. And then, an investor will be like, well, I can't get out now. I just have to ride it out. And then they waste 6 or 7 years, which is very expensive in terms of time and returns. You can do a lot of stuff in 6 or 7 years if you put your money somewhere else. So that's kind of my take on the stock market.
Well, Chris, we don't talk about capital rotation a lot. So let's talk about that now. Suppose you're an investor, generally speaking, or a trader, and you're locking in gains, whether it be in gold or silver or mining stocks or Bitcoin, whatever it is, and you're thinking, okay, I want to take profits. I want to put my money to work in another asset, not just leave it in cash. Now, gold is a perfect example. I'm sure a lot of people are doing that with gold and silver right now as we're speaking. How do you make that decision to A, there's a two-part component here. A, I need to lock in profits now. And B, I want to pick something else to put those profits in, not just stow it in cash, right? So evaluate A, which I think we have already. And then number two, evaluate B. How do you go about picking another asset to park your gains in?
Yeah. And so the key is you need a strategy generally to lock in profits. You need to have rules in place so you scale out and you're pulling and locking in profits as the market moves up. We did a recent play in gold. We got long gold. We caught a quick 15% move. We scaled out as it moved higher and we're back into cash. And now gold's, having a sharp pullback. And what you need to do is you do need to sell positions to lock in gains. We never know something for sure in the stock market, but when all the signs are there, when things go parabolic, everybody who's interested in that asset class is piling in and they all believe it's just starting. That's usually a red flag, a warning sign that you should be starting to lock in some profits and mentally prepare yourself that this ride may come to an end soon and it might not be favorable for months or potentially years again. So you don't want to give back all those gains. And a good chart for this, David, is like you look at people who got into like GDX and we look at the monthly chart here. This is like the experience that a lot of people have gone through is they got into precious metals back in 2010, 11, 12, and then they just went through, 12 years of not very big returns. And then in 2 green bars, or you could say 3 bars, which is only 3 months, the whole rally happens and they think it's just getting started. The reality is, looking at the charts, it's actually just about to end. And so that's where they get stuck in this scenario. Well, I held it for 15 years. There's no way a 3-month rally is just the beginning. But based on chart analysis, that 3 months rally was more or less is the move, and it doesn't have a whole lot of upside left. And you should rotate away from stuff like this when it goes parabolic. You look at silver's done the same thing. If you look at the parabolic moves, if you look at gold or silver miners, I mean, these don't end well, right? So to answer your question, David, how do you know when to rotate your money? Well, you know when the charts look like this. You've made good money. Be happy to lock it in, slowly scale out. Who knows where the top is? We're playing in no man's land, so nobody can nail it. It's just be happy with what you lock in and how you manage the second half of your trade. If you try to let it go higher or if you get out now. Where do you go after this? That's a good question. I don't think stocks are safe. I don't think precious metals are safe. I don't think real estate is safe yet. I think real estate's going to have a great opportunity, but I think we're far, far from the real estate market being a good opportunity where the numbers really work and where an investor can go and look at the properties and have like pick of the litter, right? They can be like, that is a perfect rental property, multifamily, whatever. Right now, homes are still overpriced. The numbers don't really work. And when things get bad, eventually rents will come down. And so even if the numbers barely work right now, they're not going to work 2 years from now when everybody's willing to just rent their house for a loss because they just need it rented to subsidize some of their mortgage payments, right? So there isn't a great spot. I think the play could be the US dollar. I think the dollar could actually strengthen in a time of global weakness. I think inverse ETFs are a great way to do it. That's what we've done in the last bear markets. We buy an
To
inverse
hold or
ETF.
to hold or to trade inverse ETFs?
They are not to hold, they are to trade. So there'll
Yeah,
be a
that's
trade
what I
that
meant.
could last, a couple weeks or a month or two. You get in, you catch a drop, and then you move out. They have to be actively traded because they carry a lot of risk in different ways. Um, so yeah, there's not a whole lot of safety. I think dollar, cash, just it doesn't matter what inflation is, earning cash and earning 4%, 4.5% a year may not outperform inflation, but I'll tell you, it sure is a lot better than losing 20 or 50% of your wealth just because you're worried about inflation is a bit higher than the interest rate. So it's about preservation and protect your capital, save your lifestyle, and wait for a new opportunity. Because if you only get into great opportunities that have a lot of upside, who cares if you got a year of dormant, of not much action? When you do put your money to work, it's got a high probability of working, and it's got a high probability of big returns. So you have to be patient. You have to let the moves come to you in the markets, in any industry, in anything. You can't force stuff. And that's what traders, unfortunately, especially swing traders and day traders, they're forcing themselves to find trades. And that's a great way to lose money. You have to let the trades unfold, like open like a flower, and then jump in, and then you take advantage of it when it's near perfect setup. So that's, I think, how you have to attack the markets and life and business and all of that is you can't just buy because you need something new to go into. Sometimes there really isn't much to go into.
It really does beg an interesting philosophical question now, hey? Because usually when you take profits on a risk asset like a Bitcoin or a crypto or a tech stock or a mid-cap stock, and you want to park your cash in something defensive, you go to gold, you go to treasuries. But now gold is the risk-off play. Where do you go for safety besides cash now in a time like this?
Yeah, you go to cash. Like cash is king. Sometimes cash is the best trade. People don't see it as a position. This is I think the biggest misconception. People see cash as wasting your money. It's not a trade. You're not doing anything. Cash is a position. You are doing something. You're protecting your capital, and you're still, scratching out a little bit of return on the interest. Cash is a amazing position to be in, and there will be a point here when the markets do reset and everything falls apart. There's going to be millions of traders around the world going, wow, imagine if I just moved to cash, how happy I'd be. But that won't happen until everybody's lost their shirts, till there's a reset, and they're like, I felt the market correction was coming, but I held on to everything. So I deal with thousands of traders all the time. This is the same scenario comes over and over again. Just realize cash is a position. It's doing many jobs. It's creating stability with your financials. It's creating some income, and it's protecting your lifestyle. What else could you ask for, especially when everything around you is falling
I
apart?
want yield. I want returns. I want steady
Yeah, yeah.
income. The cash isn't going to give me all that, Chris. It's boring. That's what I hear.
Totally. Yeah, that's fine. I can't help people with that mindset because chasing returns all the time when there isn't a good time to really chase it is going to get you in trouble. Now, the only way to do that is through an inverse ETF. Take advantage of things collapsing. And I do that. It's a different game, but that's not for the average investor, right?
Well, let's suppose you have a fund or you're a company or whatever, and you have investors, and they're asking you, why do you have all this cash that you're not putting into work right now? I don't know if Warren Buffett gets this. I don't think anybody in the world challenges him, but he's sitting on a lot of cash, records amount of cash for his company, Berkshire Hathaway. But if you're not Berkshire Hathaway, which most people aren't, you might still get investors asking you to put your cash to work. How do you go about responding to that question, especially at a time like this?
100%. His team gets it all the time. You guys are wasting our time. Get us into more positions. You got tons of cash.
Sure.
People naturally think you should be in the markets to make money. My response is, Well, I mean, I don't know really how to angle it, but like more or less, it's always not it's not about chasing the return. People who chase returns all the time and demand the money be working for them in a way that they're expecting like big returns. My strategy doesn't cater to that. I can't help people with that mindset, right? I'm focusing on people who have logic and have reasoning to be like, okay, I want to be in something when it's moving up, and I want to maintain my wealth when things reset, and then reinvest my money into an asset class when it's starting a new cycle to the upside. But if you're looking to catch every blip and dip on the charts, and you cash, you think you always have to be in trades, I just can't help you, because that's playing with fire, right? It's not always safe to be in the markets and to be diversified into all kinds of stuff. It can
How
carry
much
it
cash are
carries
you
away.
in right now?
Well, we moved to 100% cash with our strategy, so we're sitting just kind of fat, dumb, and happy right now, just
Yeah.
waiting for the next trade to get into.
How low do either stocks, Bitcoin, or gold need to move before you go in, Chris? And this is getting to the last part of our conversation. I promised viewers that you give levels, so here we go. Key levels to the downside before you get back in.
For which asset here?
Let's go through all of them. Let's go through gold first,
Okay.
stocks, and then Bitcoin in that order.
Okay, so gold for me will require, I'm just going to zoom out and get rid of this chart here. So gold's going to need a pretty big reset. Like it needs something like this. We had this beautiful run up and this giant consolidation, and it was screaming. We said, okay, we'll play this breakout as a bonus trade. Where, if you should have already physical metals if you're into metals. We played this beautiful move to the upside. What we're going to need for gold is for it to do the same thing again. It's had this run up. It needs to consolidate and build a pause. It needs some type of breaker or pause here. And then when it starts to break and run higher, we can jump back in for another trade. Now, gold may actually pull back more significantly. Maybe it needs to pull back, very significantly down into the whole 34%. Maybe if it has topped, it's got to finish the downtrend. So what gold needs to do is either build a base, a new platform to break out of, which could take a few weeks, and then we could get long on a breakout to the upside, or it needs to finish correcting and have a huge reset, which means the stock market and the economy are probably going to go through a rebalancing event where everything drops in pricing. So there's a lot to be done when it comes to gold. I look at gold. I don't use gold as making a lot of money. I don't use it as a main driver. I use the equities, bond markets, and the US dollar to using ETFs to trade. That's how I generate growth, with overall growth in my whole portfolio. Gold is a sliver. It is for most people's portfolios, unless you're obviously heavy into the metal space, and you're probably almost all into metals and miners. But gold has to give me a perfect setup. So I just wait for another one. It's not about how much it pulls back, it's letting the charts paint a picture, paint a formula or a pattern that is telling us, okay, the odds are if it breaks to the upside, it's going to go a lot higher. And if that's the case, then we'll get long. So, everybody always wants specific prices. And that's what you're going to keep asking me is like, what price, what price? I'm like, I don't really know. It's more like, what
Yeah.
have the charts drawn, and are they giving us a bullish picture? And then from there, we can calculate the pricing.
What's your sentiment on Bitcoin? Similar question. I don't have to ask you for a specific level, but if you're not in Bitcoin right now, which you're not because you're 100% cash, what does it need to do for you to, let's put it this way, what does Bitcoin need to do to convince you to get in on Bitcoin?
Yeah, Bitcoin really needs to trade sideways in a more stable range. I'm not a fan of the Bitcoin chart because it's got this broadening formation. It has higher highs and it has lower lows, which means volatility. Every move is getting larger and larger. And so, it breaks to an all-time high, and you might get long, and then it knocks you out. And then it breaks a low and goes even lower, and then you get short. And then it reverses and gets you off guard, and it makes a higher high, and then you get long again, and then it goes down and makes a lower low. Like, this type of chart pattern is noisy. I don't like it at all, because it's increasing in volatility. It's getting more dangerous as the pattern unfolds. So it needs to do a lot before I'll ever like Bitcoin again here. It's going to need to like build, some type of bull flag pattern and have a nice controlled move to the upper end, build another pattern. And then maybe after this, if it starts to break out, it could be a clean breakout. But right now, I can't really, it needs a lot of time going sideways. It needs some stable pricing. And right now it's just showing signs of money piling in and then money pouring out. And that's not the type of price action that bodes well for a high probability trade.
Finally, stocks, similar question.
Yeah, if we look at the stock market, I think the stock market could turn around here very quickly. The stock market isn't quite as volatile. I think we're going to see potentially over the next week or so, the market may stabilize and want to break higher. So it's not far away from us potentially getting long again, but we do need to see some more broad market strength in the market. So I can't give you a price, but I think in the next few trading sessions, we're going to know whether the market is actually starting another uptrend. And this was just a piece of news and a bout of selling that shook things up. It's trying to buck everybody out of the market, and then it wants to go higher, or it's going to quickly here reverse back down and actually go into a bigger reset. So again, right now we're just on the sidelines, and we have to let the charts tell us in the money flows of what we should do. So, I mean, it doesn't give you an answer other than we need to let it prove itself. Once the chart says, hey, this is actually an uptrend again, it meets our qualifications, then we can get long. And the market might want to continue to run higher.
Chris, I want to end on real estate. You mentioned real estate is not something you would park your cash in right now. I'm curious why. Rates are falling across the board, Canada and the US.
Mm-hmm. Well, I mean, I follow a lot of economic data in the real estate space, and the charts look horrendous. Everything is telling me that we're still going to have some type of weakness in the overall economy, which is, if we have that, it's not good for real estate. And it doesn't matter if mortgage rates drop that much. I don't think usually falling rates help boost home pricing, because if it's a cheaper mortgage rate, you can buy a more expensive house. When you couple that with a weakening economy, which I believe we're slowly inching our way to, it doesn't matter. People can't afford the house anyway. And even if it's cheaper, a lower mortgage rate, they're like, that's still too much. And then the other problem is when we do go into recession, the banks tighten right up. So people who qualified for a mortgage, a month before things turn sour, now they don't qualify because the banks put these. So you can't sell homes as much. They don't sell as fast because most people don't get approved. And so home buyers have to keep lowering their price so they can sell the house that they really want to get off their hands. And it creates this feeding frenzy of supply. They just start dumping a lot of supply. And I like real estate. I think there's some really interesting ways to play real estate. I mean, if we go back and look at the monthly chart, a lot of people, don't want to get into real estate because of all the legal things that go with it, and toilets and running water, tenants, all that stuff.
Yeah.
But I do think there's going to be a great opportunity, just like in 2008. I think eventually, REITs sell off. So this is IYR. So if you say you don't want to buy a home or multifamily or self-storage, you just go on your brokerage, you buy an ETF that owns those. They pay, these purple lines across the bottom are dividends. They pay really nice dividends. Now, you can see in 2008, the REITs got hammered. They fell like 75%, which is amazing because they dropped sharply. You can buy them, and the dividend yields back then. I mean, I bought ETF that was paying 16% dividend after the 2008 crash. And so these yields will be massive because the share prices come down, but the yields are still the same, the dividend distributions. And so the nice thing about these is you can buy, $10,000, $100,000, $1 million, whatever you want of these ETFs when they're oversold and they pay a high yield, and take advantage of it and earn, beautiful returns for many, many years to come. I do think we're going to see the real estate market and the REITs themselves as well fall dramatically again. I think it's going to be an amazing opportunity. And I think you can make a lot of money with REITs, real estate side of things, even more so than real estate sometimes, because you get a share that's oversold. It's way undervalued, and it can bounce back and double in value in a very short period of time, a year or two. You don't generally get that in the housing market. So the REITs are a great way to play it. I do think we're going to see real estate fall. REITs are going to get hit very hard, but it's not the time yet. I really don't. The numbers don't work. If the numbers don't work, you shouldn't be dabbling in real estate. The numbers have to be like, really, really supportive of you buying it and give you a lot of wiggle room in case you have major problems or expenses in those. So that's my take.
If you have to buy a home because you have to live in it, that's a different story. But let's
That's a
say I'm
different
already sitting on a home, and I'm thinking maybe should I either buy a second property now or sell my home either for an upgrade or a downgrade in size. I'm getting the sense that you probably would stay put on the current home for now.
Yeah, you nailed it. I mean, buying a home right now is not the end of the world if you're living in it. Homes are great investments long term. So if it's your
Sure.
homestead, I mean, buy what makes you happy, buy what has all the features you want, and just realize it's a long term investment. But if you're buying a second property or third property, I mean, I don't think you should be touching it yet. You got to wait for, I think the bottom's about to drop and we're going to see a
Yeah.
nice drop in pricing and it's going to open up the doors. So if you're patient, the right cycles will come into play and you can accumulate at the right times.
Excellent. All right, we'll put the link down below so you can follow Chris. He has a YouTube channel and a website. Just tell us what we can expect to learn from you when we go visit your work, Chris.
Sure. Yeah. Well, pretty much every morning I do a morning report. I cover what happened in the markets overnight, pre-market, what to expect today from intraday charts all the way to the long-term monthly charts. I really just keep everybody with their finger on the pulse of the market. You know what to expect. Is there going to be gaps and panic selling or FOMO? And generally, I can kind of put a thumb on how most investors are feeling and kind of I guide them through the day, each kind of day by day, so they don't get caught up in emotions. And then I share my trades. I manage my own portfolio. That's all I do, and I share my exact portfolio and trades and allocation with subscribers. So we all navigate these markets together, and I have the best intent because it's all based on my portfolio, the exact trades that I do.
Excellent. Thank you very much, Chris. Great update today. Very timely update. We'll speak again soon. Don't forget to like and subscribe to this channel and subscribe to Chris's channel. Again, links down below. See you next time, Chris.
Thanks, David.
Thank you for watching. Don't forget to like and subscribe.